Car loan payments can be a heavy burden, but you don't have to face repossession to escape the debt. In this video, we'll explore practical ways to get out of your car loan, including refinancing, selling, and lesser-known loopholes that could save you money. Before we dive in, don't forget to like and subscribe for more debt solutions, money tips, and smart financial strategies. 10. Understanding the total cost of your car loan. Before making any moves, you must know how much your car loan is costing you each month and year. This includes interest payments, fees, and any penalties for early repayment or changes in terms. Knowing the total cost helps you decide if refinancing or selling is the better option for you. Lenders are required to provide this information if you request a full payoff statement from them. This step is essential because it shows you the financial picture beyond just the monthly payment. Understanding the numbers allows you to make a plan to reduce costs without risking repossession. When you have accurate figures, you can negotiate better terms or plan for an early payoff safely. 9. Considering refinancing for lower payments. Refinancing replaces your current loan with a new one, often at a lower interest rate or better terms. This can reduce your monthly payment, making it easier to manage without falling behind on bills. Lenders may offer longer repayment periods to lower costs, but this can increase total interest paid. It is best to shop around with different banks and credit unions to find the best refinancing deal. Refinancing can also help if your credit score has improved since you first took out the car loan. A lower interest rate means more of your payment goes toward the principal rather than extra charges. 8. Selling the car to pay off the loan. If the car is worth more than what you owe, selling it can clear the debt and remove the burden fast. You can sell privately to get more money or trade it in at a dealership for a simpler process. The goal is to cover the loan balance and avoid negative equity, which means owing after the sale. If the sale price is close to what you owe, you can pay the difference to fully close the account. Selling a car can feel like losing something, but it can also give you freedom from loan payments. This approach works well if you can find cheaper transportation without creating new debt. Act quickly before the car depreciates further, which could reduce the value you receive in sale. 7. Using a voluntary surrender as a last resort. Voluntary surrender means returning the car to the lender before they take it through repossession. It still affects your credit score, but is slightly less damaging than forced repossession events. This step can help you avoid additional repossession fees and reduce the lender's storage costs. If you cannot refinance, sell, or make payments, this is a way to stop further interest buildup. Lenders may still try to collect the remaining balance after selling the vehicle themselves. You can negotiate with the lender for a reduced payoff amount after the surrender is complete. It is important to document all communication and agreements during this process carefully. 6. Negotiating with your lender for modified terms. Many lenders would rather adjust your loan than risk losing money through repossession actions. You can ask for lower interest rates, temporary payment reductions, or extended repayment periods. Being honest about your financial situation increases the chance of receiving positive changes. Loan modification agreements can make your payments manageable without losing the vehicle. Always request the terms in writing to avoid confusion or disputes about what was agreed later. Modified terms can reduce stress and give you breathing room to get back on financial track. 5. Renting out the car to cover payments. If you cannot sell the car, consider renting it out to earn money that goes directly to payments. There are legal car-sharing platforms that connect you with renters while handling insurance needs. This option can generate enough income to keep the loan current without draining your paycheck. You must check with your lender and insurance provider before starting to avoid contract issues. Renting out the car works best if you do not need it for daily transportation all the time. It is important to screen renters carefully to avoid damage or late return of the vehicle. This method can also give you time to plan a long-term solution while avoiding missed payments. 4. Using a side income to pay off the loan faster. Taking on extra work can create additional income dedicated only to paying off your car loan. Side income can come from freelance work, part-time jobs, or selling products and services. Directing all extra earnings toward the loan helps you reduce interest and pay it off sooner. It requires discipline to avoid spending the extra money on non-essential purchases or luxuries. You can calculate how many months earlier you could finish payments with extra contributions. This strategy works best when combined with cutting other expenses in your monthly budget. The faster you pay off the loan, the more you save in interest charges over the total term. Extra effort now can bring long-term relief and free up income for future financial goals. It is a proven and safe way to take control of your debt without risking your transportation. 3. Trading down to a cheaper vehicle. If you still need a car, consider trading your current one for a less expensive, reliable model. Dealers can help arrange the trade so the loan balance transfers to the cheaper replacement. This can lower your monthly payment and reduce the total debt amount you need to repay. The key is to avoid adding extras or costly upgrades that increase the loan balance again. A cheaper vehicle still meets your needs while giving you financial breathing room each month. Trading down can also reduce insurance costs, which adds to your overall monthly savings. It is important to choose a car that is dependable to avoid repair costs that offset savings. This strategy lets you keep transportation without carrying an unmanageable debt load. By downsizing, you maintain mobility and improve your financial stability at the same time. 2. Applying for a low-interest personal loan. A personal loan with a low interest rate can be used to pay off the car loan in full. This is only smart if the rate and terms are much better than your existing loan agreement. You can then make payments on the new loan, which may be more affordable and manageable. Banks, credit unions, and online lenders may offer better terms, especially with good credit. Be sure to compare the total cost of the new loan against what you still owe on the car. Personal loans often have fixed payments, making it easier to plan your monthly budget. This can also protect you from the risk of repossession while lowering your interest cost. Using this method can be a quick way to restructure debt without losing your vehicle. It is most effective when combined with spending cuts or extra income sources. 1. Building a debt repayment plan and sticking to it. The most powerful method is to make a realistic repayment plan and commit to following it. List all sources of income and expenses, then allocate enough to cover the loan each month. Avoid spending on wants until your car debt is under control or fully paid off completely. Set clear goals with deadlines so you stay motivated and can track your progress easily. Small extra payments each month can greatly reduce interest over the life of the loan. This discipline prevents missed payments and protects your credit score from damage. From lowering your interest rate to selling your vehicle, there are smart ways to get out of a car loan without losing control. Which option would work best for you? Share your thoughts in the comments. And if this video helped you explore debt-free strategies, don't forget to like and subscribe for more practical tips, financial advice, and money-saving ideas. More solutions are coming soon.